Welcome to the Remarkable Retail Podcast, Season 4, Episode 22, the grand finale. I'm Michael LeBlanc.
And I'm Grandmaster Steve Dennis.
It's been such a great season, Steve, and I really appreciate being on the mic with you. And great news, as we've said, we're renewed for Season 5, so look forward to that kicking off on July 12th.
Yeah, got that Netflix money now coming in, so high production values, 4K, 5K, I don't know.
There you go. Well, I think you got a new mic in your in your kit, so maybe there'll be a bit of bit more sense. And we've got some very exciting news that we'll share a little later in the month about some support and sponsorship we're getting actually for the series. So we're very excited about that and very excited to share that. But we'll keep that under wraps for now. It's a solo episode, so as is our wont, we want to talk about predictions. We want to go all the way back and look and evaluate how you did in terms of your predictions. So we'll get to that right after the news. So let's kick it off with what's in the news. Inventory overload. I keep reading warnings, red, yellow, green, yellow lights from lots of retailers. What are you hearing out there?
Oh, I mean, this is really such a train wreck in a lot of ways. A pretty big surprise. It all kind of started with, which we talked about, I guess, a week or two ago, with Walmart's earnings and their surprising increase. Then the Wall Street Journal wrote an article about, in general, how inventories for the industry are up like 26% or something in total. And then, and this was the one that really kind of blew my mind, I wrote a Forbes piece on it. Target comes out 3 weeks after their disappointing earnings announcement and revises their forecast. It says they've got so much stuff, they're going to have to aggressively start promoting it, canceling orders, all this kind of stuff, which really kind of sent shockwaves through the retail industry. But they're not alone. I was looking at some of these other figures. Ross stores, their inventory is up over 50% on negative comps for the quarter. Target, Walmart, we talked about. TJX, which had actually pretty strong comps, like I think 7-8% range, but their inventory is up like 33, 35%, something like that. Kohl's negative comp, their inventories are up over 30%. So, it's hard to understand how big, sophisticated companies could get it so wrong. Certainly supply chains.
Too much inventory or too little planning? Like, what's going on here? Like, we all knew, I mean, we've been talking about it for, I don't know, a couple of seasons, that eventually consumers will turn their minds to experiences and services and flying and traveling and getting back to normal life. And, they'll stop buying more TVs because they just want to get out of the house. Like,
I mean, there's clearly some of it, and it's really hard to parse out from what people have talked about. But I mean, it's clear from what some folks have alluded to in their announcements, as well as some things I've been hearing, that there's definitely things that are specifically related to the supply chain, things arriving too late, and retailers trying to grab stuff early. So that's part of it. But if you listen to what Brian Cornell talked about and what some others have talked about, they do put a lot of this on just not anticipating consumer spending correctly. Most of that seems to be related to what you were just talking about, which is this mix issue that, they're not able to sell casual apparel as much anymore because people are buying, more going out apparel, and they've got the TVs or the furniture or whatever. But it still is shocking to me that multiple big companies could get it so wrong. And when you layer on top of this, which I guess we'll talk about in a second, but just in general, I mean, it definitely seems like we're seeing some deceleration of consumer demand. So to have a lot of inventory at a time where it might be tough to drive positive unit sales, it's a scary situation. So we'll see.
We'll see. I mean, I see this deceleration of demand in one way. I mean, generally at a broad economic basis, sales are still strong in the U.S. The U.S. consumer is tapping into all those excess savings during the COVID era, and they're powering through inflation. But not all consumers, right? This is where it gets to that bifurcation, right? And now I got to spend $100 or whatever to fill up my tank of gas and put more food on the plate. That's going to crowd out a lot of discretionary spending, right?
Right. Well, there's the whole inflation thing, and what we're seeing so far, because we're recording this on Friday, the U.S. Consumer inflation numbers came out today showing that inflation is not yet moderating, also shows consumer sentiment at an all-time low. Across the last couple of weeks, we were seeing that consumer credit is going up quite a bit, not close to record levels, but going up. And savings is coming down, still at a pretty healthy rate. So it is fair to say that the consumer balance sheet is generally pretty good, but it's clearly weakening. And anecdotally, and I think if you look at the forecast that some of these retailers are talking about, I mean, they definitely are signaling we expect consumer demand in many areas, particularly if you're not serving that upper income customer, to your point about bifurcation, is going to slow down a lot. And I think we'll really, really have a clearer picture with the next quarter, because I think we are seeing this shift in consumer spending. I think we are seeing inflation start to really affect things. And they'll have had 13 weeks to try to move this stuff. I think the X factor, because I don't think they're going to be able to do it by like radically increasing the amount of units that get pushed through. I think the X factor is going to be, how much of this mix is really, this season goods versus, sitting around waiting for the fall, as well as how many orders can they get out of? Because if they can, if you just play with the math, like if receipts are constant and you're up 33% in inventory, you got to run about that sort of comp, across the next few months to get back to where you want to be. But if you're able to really reduce your receipts substantially, not to get into too much math here, but, there's an opportunity to close that gap more than might be apparent. So we just don't know, other than clearly they're trying to do, Target and others are trying to do that. Just supply and demand, I think, is going to continue to put a lot of pressure. Food costs are still very high, but yes, I think because of the glut of inventory in those categories, that rate of inflation, I think, is going to be down actually very, very noticeably pretty quickly, because these companies are clearly convicted in dealing with this fast so that they can bring fall goods in, basically.
Yeah. Assuming they have something anyone wants at this point, which is also the other, lots of inventory, but doing the right stuff. I mean, I guess at some point somebody wants everything, but anyway, we'll see. Speaking of somebody wants everything or somebody wants something, so Kohl's came out and announced a specific suitor, and took me a little bit by surprise. Well, I didn't. So the suitor, they have a 3-week exclusivity, I guess, to try to reach a deal, is this company Franchise Group, which I had never heard of. They are a small holding company that by far their biggest holding is Vitamin Shoppe. When I heard this, I was like, what? Who are these people? Why does this make any sense for them other than doing something? Is Kohl's a franchise? Did I miss something? Is Kohl's a big franchise?
Yeah, and I don't think they're going to be turning Kohl's stores into like really big vitamin shops. If anybody's ever been there, they seem a little bit big for that. So I don't get this. It seems either desperation or Kohl's isn't really serious about wanting to get acquired, or it's a stalking horse for somebody else. So I haven't heard anything other than, people speculating similar kinds of things, but I don't have any insider kind of information or perspective on which it is. I still think Amazon should buy them. So what do I know? But it doesn't seem like that's likely to happen unless Andy Jassy just goes, "Oh, come on, get out of my way."
So you and I have been, in fact, when we first met, talked about our lack of belief in this whole retail apocalypse narrative. But more and more, I think we're starting to think about, or you're starting to think about, or frame it as a disruptor apocalypse. My goodness, there's been some tough news in the press this week. But
no, I think, I mean, I was very critical of the retail apocalypse pretty early. I wrote about it in the first edition of my book, which is now, more than 2 years ago. So, I've been on this for a while. And I think by now it should be pretty clear to everybody that for the most part, it is nonsense. In my book, and we almost edited it out in the second edition, where I suggested that, perhaps we will be talking about a disruptor apocalypse in the future. And this idea that WeWork was kind of the canary in the coal mine, I think is the line. I didn't go back to look at it, but it's something like that. And, It's been pretty apocalyptic for just about all these companies. We're going to talk about it a little bit more in the predictions part here in just a second. But just in the last couple of days, TheRealReal, which is in the high-end resale business, their founder and CEO, Julie Wainwright, has left after 11 years. They just reported a surprisingly weak quarter. Now, we talk about all the high-end fashion businesses coming back. They had a very weak quarter. Their operating margin, here we are, 11 years in, they have a negative 30% operating margin. The stock is down over 90% in the last year. Now, the stock market's obviously had some issues and generally has been down.
But a downdraft.
90% is incredible, even if you sort of say, well, there was excess frothiness in general in that market. Similarly, StitchFix, this one really is starting to look like a train wreck. Their revenue growth has stalled. Again, they're in the fashion business, higher end. You would think that business would be on fire. Trunk Club has just exited the business, though that wouldn't be in the numbers. But they're losing customers, which even some of the brands we talk about that have had their stock prices go down and are having losses, most of them are still gaining customers. So they lost a lot of customers. They're laying off 15% of their salary staff. And here's another stock that is down almost 90% in the last year. And just a little while ago, I think a month or so ago, Katrina Lake, who is, was kind of that first wave of founders of these digitally native type brands. She is now kicked upstairs to the being executive chairman or something like that. And there's some new leadership there. So the more data we continue to get, there have been very few positive stories in this disruptor group. And as we talk about in a second, most of the high profile brands that have been around for a while have seen their valuations really, really collapse in the last 6 to 12 months.
Well, let's end with a couple of positive things. First of all, the news is actually pretty good for a couple of companies I saw, both Lululemon and Tractor Supply. We've had some executives on from TSE Tractor Supply. They posted some great results. So, it is possible to make money in retail still.
Yeah, Tractor Supply is just one of these great stories. I was really first seriously introduced to them because I spoke to their management team about 4 years ago, and apparently they listened to all of my advice, and that's really the only explanation for their success. No, they.
There you have it, ladies and gentlemen.
I was looking. Their stock is up 3x over 5 years. They are now at just over 2,000 stores. They're planning to open 75 to 80 this year. Their sales were up, I think, 8% or so in the last quarter. Strong operating margins. I mean, it's just and very. They are doing a lot of work on omni-channel, harmonized retail, whatever you want to call it. But it's certainly a business that has really been driven by the strength of its physical footprint, and it's just a great story.
Yeah.
As is Lululemon. I think one of the things with Tractor Supply is they were kind of, I think Lululemon, I feel like, has been sort of in the common vernacular of retail for 5+ years. Tractor Supply, I figure, was kind of like, they were like under the radar for a while, and they've just really, really exploded. They're on a good trend before. Hal Lawton has been their CEO for 2 or 3 years now. And just continue to just light it up.
Yeah, they're doing great work. And speaking of other great news, I saw you post a picture with our friend Ron Thurston. So you had some time to chit and chat with Ron, had a coffee in Dallas, I guess.
Yes, I loaded up the horses and pack mules, and we went all the way out to the great wilds of Grapevine, Texas, which some people may know is just north of DFW Airport. I suspect many people have been through there. And we met up as part of Ron's Retail in America tour. He's in Dallas, just wrapping up here in Dallas today, I believe. And we got a chance to chat for a couple of hours about a lot of things that could have been on air, a bunch of things that absolutely would not be on air. And it was
heard
really,
it on the grapevine, so to speak.
Oh, heard it on the grape. I like that. Damn, I wish I had thought of that. About that. But it was great to see him and just learn more. We listeners should go back and listen to that episode because it's a great episode, but got into a little bit more of the planning, logistics, and the great experiences he's having. And I really admire his creativity and it's a big risk to like pack up and, with your spouse and head out on the road for multiple months. But it's very cool, very interesting.
Well, and a reminder to everyone that was our last episode, episode 21. It's a very popular episode, so check it out. It's a great interview with Ron. All right, so as I said, this is our last episode of the season, and we've reserved it for predictions. We're going to go back and see how your predictions are turning out so far. Let's start at the top. The stores strike back again. So you predicted that there would be, if not a renaissance, lots of energy and positive vibes around stores. How do you think you did?
I feel like so far I'm on track. Obviously mid-year review, so maybe things could fall apart. But I think if you look at what's happened the first 6 months of the year, we've seen, if anything, stores become, in a lot of respects, more important. A lot of the traditional retailers have been really leaning heavily on their stores for e-commerce fulfillment. And we've seen a moderation in general in e-commerce, with physical stores doing, in some respects, surprisingly well. So, I've been pushing against the retail apocalypse narrative forever, which was kind of the first time I brought up this idea of the stores striking back. Yep. But going into COVID, I think people probably assumed that with this acceleration in e-commerce, that would make things even more challenging for stores. And it turns out actually almost the exact opposite.
The profitless prosperity of disruptor brands comes under increasing scrutiny. You don't have to be necessarily a listener or follower of our podcast to see the downdraft in the stock market on the valuation of these firms.
Yeah, well, I think when we did an episode on this, one of the things that I took accountability for was I've been predicting that this scrutiny would come much earlier, that some of the hype around many of these brands and the sky-high valuations had to come back down to earth. And I was definitely too early on that. And I think some of that was I didn't understand the dynamics as well. But a lot of it, of course, is what happened during COVID, with things shifting back to being more online dominant. So that kind of kicked the can down the road a little bit. But since the beginning of the year, virtually all of these disruptor brands that are public have seen their valuations collapse considerably. I'll just mention a few real quickly. Since the beginning of the year, Warby Parker's down 63%, Allbirds down 66%, Wayfair down over 40%. Even Chewy, which just reported a profitable quarter, so I guess I can't put them in the category of totally profitless prosperity, but it's one of the first times they've shown a profit. Even Chewy is down 50%, Peloton down 65%. So pretty much across the board, we've seen a whole reevaluation of these business transpire. And I've also heard some of this has been reported, I think, pretty publicly. Others things I've kind of heard through back channels is that there have been quite a few down rounds in terms of the private companies that are taking in new investments. So I would say I did pretty well on this one.
I'd call that a hit. If we were playing Battleship here, that's a hit. All right, another good segue. Let's talk more about stores. In this case, you had a prediction around Amazon. Amazon double clicks on its physical dreams. More stores, more fresh, more go, style. What's your evaluation?
I would say I'm mostly right, but I suppose this is up to a little bit of interpretation. The data is not as clear here. But what we have seen is Amazon announce several dozen more of their Amazon Fresh stores. So these are their traditional grocery formats. So they seem quite committed to that and are starting to ramp up the rollout. Also, continuing to open Amazon Go stores. There's also several dozen of those around the country, and they are experimenting with different sizes and locations. And so I think,
but not thousands, right? You remember when they first came?
Not thousands. It was
going to be 3,000 Go stores. It was the end of convenience stores. Hey, you Couche-Tard guys in Quebec, you're finished. But it didn't play out that way, right?
No, this is certainly much more of a slow roll, and that's why I say I don't think the data is quite as clear here. They could have closed the Amazon Go stores when they closed what I call the land of misfit toys. There are other formats which were quite, as I often say,
4-star
range. Yeah, so they're good at naming stores in a ironic way, because Amazon 4-star was very much 1-star. Amazon style remains to be seen exactly how stylish it is. But in any event, I think they are committed to the Amazon Go store, and they keep investing in it. And they just are making their first step into kind of the department store apparel world with Amazon Style, which they opened up a couple of weeks ago. But, and I guess this doesn't necessarily prove it, but last quarter was the first time, I think, in the history of the company that physical stores grew more than online at Amazon. Way smaller base.
Percentage-wise.
Percentage-wise. So, but we've also seen the head of the overall consumer business, Dave Clark, leave.
Yep.
So I'd say definitely pointed in the right direction, but I'd like to see more data before I'd really put this in the clear W category.
Yeah, I'm clearly of two minds around Amazon Fresh. On the one hand, the just walk out technology applied at a large grocery format's pretty compelling. On the other hand, it doesn't excuse them from executing flawlessly like many of their competitors do. Big experienced grocers, you've had that firsthand experience, right? Out of stocks, shelves. It doesn't matter what technology there is if the basics of retail merchandising aren't more than double clicked, right? They got to be nailed, right?
Yeah, and we touched on this on a previous episode, and I've written about this in Forbes. As much as I absolutely believe that Amazon has to get much more deeply into physical retail, so far they haven't been very good at it. So, and I think a lot of that has to do with a really different mindset they need to take to most of these stores. Whether they will really do that or not and learn the lessons they should have learned perhaps by now, one could argue with Whole Foods in particular, remains to be seen. So I feel like I'm always going to be a little bit, or at least I shouldn't say always, but for a period of time, there's always going to be a little bit of a caveat around how I talk about Amazon's physical stores, because they need more physical stores, but they certainly need to be better at executing them than they've demonstrated so far.
So our last guest, Ron Thurston, very popular episode. He made me laugh a couple of times. One of them was when we asked him what he was hearing in the, on the road in his trailer, and we said, "Are you hearing a lot about the metaverse?" And he literally laughed out loud. Metaverse. So your prediction, metaverse. Between crypto and the metaverse, what are you feeling? You weren't a big fan of it.
Well, I guess where I continue to be on the metaverse so far is that it absolutely, the potential of it absolutely needs to be explored by most retailers. But the idea that it's going to be important anytime soon, I think, is just silly. And so far, we've seen some interesting experiments. I have yet to hear of anything that anybody seems particularly excited about. And we know that our friends at Meta have blown through a ton of money in this division.
That's an understatement.
Yes, right.
Like a ton of money. Like when I say a ton of money, I don't think $10 billion. Like I think, a lot of money. That's an epic amount of money. They're making a big bet, even for a business of their size, right?
Right. So you'd think for like $10 billion, you might want to have, $10
more than a store in
Soho,
more than a store in Soho, maybe, or wherever they set up their store. Yeah.
Right. So this doesn't, I don't mean to suggest that this means it won't be big at some point, but this idea that this is going to be transformative to retail over the next few years, it's not happening. Write that down.
I think I'll give you a hit on that one, because the fact that we still talk about this and amongst all the other things that are going on in retail, I think is disproportionate to its importance. To your point, right? And speaking of overhyping, you talked about hyperbole remains the greatest thing ever, and you were saying that in context of a whole bunch of things: digitally native vertical brands, buy now, pay later. How do you feel?
I mean, this is a bit of a cheat. Maybe I added this to get to 10. Because that was the title of the article, but because it's not exactly a prediction. I think it's a truism, but I guess I added it in particular because I felt like going into this year, back in January when this came out, there was so much talk about all these different things that are going to change retail forever. So metaverse, we just talked about, NFTs, buy now, pay later. And I think, they get a lot of heat. It's more hat than cattle, as we say here in Texas, right? So I think that continues to be the case.
Say? More what than cattle?
More hat than cattle. It's all show, not a lot of substance. And again, it doesn't mean that that there isn't some there, or that some of these things won't be important down the road. But to your point about the metaverse, it gets so much attention and hype out of proportion with its importance in the near term.
Mm-hmm. All right. So those are your hits. Now let's get to misses and maybes. So you talked about understanding buying versus shopping becomes more important. First of all, what did you mean by that? And tell us about where you're thinking you may have missed or be off the mark with it.
Well, if I have any say in the matter, which I think I do, we're going to do an episode on this in the not too distant future. But this idea of buying versus shopping is really understanding how the world is kind of bifurcating, as I love to say, into kind of two types of fundamental purchase occasions. Buying being more, I'm running an errand, I'm trying to get something off my to-do list. I'm trying to be fast and efficient. That's sort of the fundamental thing, which, the internet is great at, places like Walmart are great at it. But you're not generally seeking a very emotionally fulfilling experience or putting together an elaborate solution. That's really what more shopping is. It's more discovery. It's more complicated. And I think what we're seeing is that the world's getting pretty good at saying, and you can even look at the way real estate is configured, like the neighborhood shopping center is built for buying, right, for the most part. Malls and lifestyle centers are built for shopping, and everything. And the thing in the middle is the thing that's getting hollowed out. So I think my prediction was more like people would start to appreciate this more, maybe even use this language more to start to explain how they're driving their strategies, whether that is a real estate strategy or whether it is a retailer strategy. I think the data supports generally that this is happening. But I wouldn't say that it is happening quite as quickly as I might think. And I certainly don't feel like this language is really making it into the broader market. So that's why we have to do the podcast episode to completely change how the retail industry speaks about purchasing.
just so you don't have to tick a little X on a prediction. But I also think and you've often made this point around talking around at a strategic perspective around omni-channel, that it's not very helpful to help or guide retailers in terms of what to do with that, right? And I think that you're creating these categories, I think, is far more illustrative of, okay, I can work with that. I can figure out something to execute along both those parallel lines or one or the other, right? So I think it's particularly because I think it gets at, I'm always about, as I think you are as well, like, starting with the customer. And if you understand the customer intent and you understand the customer's options and how you stack up in that set of options, that helps inform your actions. And I think, in context, it makes a big difference as to why, like, we'll maybe get to this in a second, but one of the reasons why JCPenney is losing is they haven't really picked a lane. Like, they're not experiential enough or differentiated enough to be shopping. And they're not convenient enough or inexpensive enough to do well at buying. And there's plenty of other choices. So because they haven't really picked a lane over the past 20 years, they're just getting, chipped away at by all sorts of competitors. Now, a lot of that has to do with their real estate. But anyway, so I think it's not just to be cute about coming up with a framework. It's about how does this help you decide how to formulate your strategy. Yeah, I think you give yourself a miss on this one. This one might be a not yet or too early. Maybe we'll create a fourth category because I don't know. I think people will turn their minds to trying to figure this out at a more real. That doesn't mean they're going to be successful at it, but
it's tough to be a pioneer, Michael.
Arrows in the back. All right, let's talk about the next one. The Great Reconfiguration gains momentum. What did you mean by that? And I guess we're in the misses category. So where do you think you fell short?
Well, this is another one where I think it's going on, but not as quickly. So I'll give you the snapshot version of this. We did do a whole episode on the Great Reconfiguration, but what we're really getting at is that brands, we're seeing this blurring of the line between digital and physical. We're seeing the role of stores changing and just in general, this kind of hybridization of everything. And also kind of the brands operating more as a platform. So the lines of kind of conventional structure of channels and formats and these sort of things starting to become more blurred. And this is causing retailers to change their go-to-market strategy. So good evidence of this, going back to what we were talking about with Target, is instead of thinking, here's stores, here's online, separate supply chains, we're now creating a more hybrid store, a more hybrid supply chain to support that. Walmart's very much moving in this direction. Nike, in thinking about the blurring of the lines between wholesale and direct, really kind of changing up their strategy in a very fundamental way. So I think we're seeing some of this go on at a somewhat increasing pace, but I'm not seeing as much kind of radical changes to strategy. Some of that I think is just, inherent to retail, that retail is slow to change. Some of this, I know this came up in a couple of other episodes as well, is because we're getting this post-COVID bump in revenue. Some retailers, though, recent events are maybe starting to make people wonder about that. But, we've had several quarters now where results look pretty good because they were comparing to absolute abysmal results. And maybe that's creating a sense of false security or a lack of urgency to transform more.
Good comps quickly over a bad year, right? The easiest way to hit your bonus.
Right.
Have a bad year the prior year. All right. Well, let's move on to... And you and I tried to figure out a best title for this. The best we can come is The Jury is Out. But basically, it's a little wishy-washy as in maybe so, maybe not. But let's call it too soon to tell. The jury is out. Moderate department stores will experience a dead cat bounce. And before you send us all the listeners send us hate mail on that.
No violent language.
No violent. That is a Wall Street term for explain dead cat bounce and your prediction.
Well, you could sort of visualize perhaps what I mean by this, because if you have a dead cat, they don't actually bounce. I mean, I've never tried this. A little bit.
And then they come down to ground pretty quick, though.
Yes, and to be clear, I've never experimented. This is not empirical data, but this is what I can intuit. But yeah, the idea is that there's a bounce, but you don't stay in the air. That is a episodic sort of nature.
It's not a lively event. It's just
yes, and it
one direction, and then
you don't stay in the air. Is I think ultimately the big takeaway. And so what I believe about moderate department stores is that we're going to see significant improvement in the results, which so far has absolutely been the case. But that is not a real solid, sustainable improvement because nothing has fundamentally changed about the strength of these businesses. So pre-pandemic, all of the moderate department stores were struggling to varying degrees. Their stocks had been down, comps going nowhere, mediocre performance everywhere from terrible in JCPenney's case to mediocre performance on the part of Kohl's, Macy's, Dillard's, a bunch of others. So now there's this kind of narrative emerging that department stores are back. And I would argue department stores are better than 2 lousy years, but better is not the same as good. And I think what we will find that once we get kind of past this, people replenishing their wardrobes, going back out, traveling, whatever, some of the things that are driving the numbers up, we will find ourselves a year from now, either at or worse than the performance of 2019, which was a pretty mediocre year.
Well, what's interesting is we do talk. I tell you, when we first started our podcast, I didn't think we'd be talking so much about department stores because I just thought they would kind of fade from the news, just fade away in terms of importance. But they really, we talk about them a lot. We just talked a lot about one of them in the news just now, right? There's still lots of activity happening in the sector. So there's a lot of energy in the sector. That's for sure. We still talk about it.
They're still big. On an absolute basis, they're not as big as they were in the past, but they're still quite big. And they're also so big in terms of revenue. But the other thing, which is, of course, out of proportion with their economic value, but when you think about a large power center that has a Kohl's, Kohl's is an anchor tenant. If you go to any regional mall in America, you're going to find, 2, 3, 4, 5 department store anchors. Yeah. So, they're still part of the zeitgeist, I guess you could say, of the way we think about retail. Now, most of them are significantly underperforming in most of those locations, but nevertheless, they have this big footprint,
including in their
as well as the history,
including in their fundamental role. Right, they're anchors of malls because their historical role was to drive traffic to the mall. People would come to the anchors and then go meander through the hallways, right? So they're even failing, I would say, at one of their fundamental original roles was literally to be an anchor. Now, I guess you could say the anchor around the neck in some cases.
I was going to say, I think, at one time I played around with an idea called From Anchor to Anchor, the history of the American department store. Because yes, there's a different term for anchor, which is actually much more descriptive of where we find ourselves today than back in the glory days of the 50s or whatever, before I was born.
Well, let's talk about the next one, JCPenney. I mean, we've been waiting for the penny to drop on that one for years.
Well played.
Yeah, thank you. You thought they'd take over the mantle as the world's lowest liquidation sale, but they have a new leader. They've got they were swinging the bat allegedly, or perhaps for Kohl's. I mean, what's going on with JCPenney, and how are you thinking about him?
Well, part of the problem here on this prediction, which I'm convinced I will ultimately be right about this, is because they are no longer public. We do not have as much information about how they are actually doing. My assumption is they continue to do quite poorly. I know some of that from some anecdotal information from talking to some vendors. I took a look at the Placer AI data about store traffic, and their traffic is worse than Macy's, but actually better year to date anyway than Kohl's. But we don't know how that translates to business. We don't know how that translates to profitability. But when I look at JCPenney in the competitive set, it's very hard to point to what is their level of differentiation. And given that they've been on a slow slide to oblivion for 20 years, what can you point to, at least so far, that is going to meaningfully change what they're doing? And I think, they're fundamentally very disadvantaged by their real estate. And so it's one thing to improve your service a little bit or have some interesting brands. I mean, they've been trying to do that for 30 years. Yeah. And so this is nothing about their new leadership. I wish them well.
And Mark Rosen came out of Levi's, right? He got a strong pedigree, and he wants to change the focus to consumers, right? I mean, is that the secret sauce, right?
Bold idea. Yeah, so I just think they have so many structural issues that, and they're in what will, I think prove to be, after this little bump here, the dead cat bounce will prove to be a continuing contracting sector. So, when you're in a contracting sector and you're not growing market share within it, that's just a sign that your days are numbered.
Yeah. All right, let's talk about the last one, which is, for those of you listening who are of a certain age, happy days. Jump the shark. That term, jump the shark. That's where that comes from those of you younger folks out there. That comes from a particular Happy Days episode. You can look that up on Wikipedia. But you thought convenience wars were jump the shark. Talk about what do you mean by jumping the shark, and how are you feeling about this prediction?
Well, I was probably a little fast and loose with the term "jump the shark" to have a catchy headline, which is, of course, what I'm always going for. But we have been in these convenience wars, kind of this ever escalating battle to get things to consumers more quickly, and that's gone from 2-day to 1-day to same day to, in some cases, with some of these ultra fast delivery companies, 20 minutes or a half an hour. And to me, it always seemed like a race to the bottom, because the cost of doing it seemed just out of proportion with what consumers were willing to pay. And of course, in many cases, consumers weren't actually charged anything. So when your prices don't go up, but your costs do, I don't know. I'm not that good at math. That seems like a recipe.
That's that land grab stuff, which, never works.
Yeah. And so, in addition to the sort of hype around this, which is causing a lot of people to basically try to play catch up with Amazon, you have on top of that venture capital money going into companies like Instacart, DoorDash, those sort of players, but also sort of are the Getters and Jet, or not Jet,
the super fast, the
super
15-minute guys. Yeah.
So again, this is where it's hard to point to a ton of data to say like, wow, the music is stopping, get off the dance floor. But we have seen a number of these ultra fast delivery companies pull out of markets. A few have shut down, quite a few layoffs. Definitely heard about some down rounds in in funding, or just the general sense that venture capitalists aren't going to touch these deals anymore. So among the disruptor model, that seems like, that's really coming to an end. But I think we're also seeing a lot of the bigger retailers basically emphasize more store fulfillment and having the customers come get it, because the economics of home delivery aren't generally very good.
And getting worse, right? Because you've got I was talking to retailers recently, and they're talking about huge fuel surcharges from their couriers, right? Not only you've got volume surcharges. I mean, we all experience it firsthand. The cost of gas has gone up dramatically, and that's going to leave a mark on e-commerce, I feel.
Well, there's an extra, I think there's a whole extra squeeze that probably would have happened anyway. But because fuel is going up, labor costs generally going up, all the input costs or not all of them, but most of the input costs are going up in a way that it doesn't seem possible to pass on to consumers. So, again, it's like free returns. We've sort of taught customers to expect a certain kind of price point for ultra fast delivery. And I think generally the experience has been, as retailers have tried to pass that on, whether they do it in marking up the price of the item, or, it's more explicit in terms of the service fee, there tends to be quite a lot of resistance.
Remember the days as a retailer you used to make a bit of profit on shipping fees? Remember those days?
Yeah. Oh, absolutely. No, we had.
That was in my lifetime. It's crazy.
I ran a division at Sears, $700 million division, where we made something like $15 million a year on delivery profits.
Shipping and handling.
So,
that's an H. Yep.
Yeah.
Wait, I think there's one thing that we should probably explore a little more in this rapid delivery, and that a lot of the rapid delivery isn't done by automobile. So there's all kinds of things that are happening in that intercity that may not be impacted by the price of fuel. And who knows, there may be a kind of an ironic twist where it gets more affordable, not less, because it's on a bicycle, it's on a scooter, it's on whatever, right? It's hard to navigate big, complex downtown cities in a car and get anywhere 15 minutes. I mean, you basically can't even pull out into the lane in 15 minutes in Manhattan. So,
and I think in some respects, this is a little bit, and I don't want to like overly caveat these predictions, but I think in a lot of cases, the devil is in the detail. It's not that there won't be some ultra fast delivery in the future. I believe there will be, just like I believe, buy now, pay later, and some other of these technologies, like there is a way for that to be a real business. It's just that the hype and the investment has gotten so over its skis in terms of where the potential really is. So I think what we're seeing is, or we're going to see, is a shakeout. We'll see some of these companies go away. I think you're absolutely right. There will be cases where it's like, well, maybe in urban markets, this type of, bicycle delivery or drone delivery or robotic delivery or whatever actually works. In other cases, it'll get narrowed down to the customers who are super busy, have a place for stuff to get delivered. So, there will be a premium segment of people that can offset the cost of the high service. But as a broad-based, everything's going to 20-minute delivery, that's not going to happen. And I think it's becoming more obvious that that's not going to happen by the day.
Yeah, I guess your argument is valid in that it will be with us, but it's very, in some ways, maybe it's just purely densely packed urban cities, right? It only works where it works, which is, it doesn't work outside in, the Great Plains of Wisconsin, right? It's just hard to do 15-minute delivery. And unless, I don't know, maybe there's drones. We haven't talked about drones all year. We should probably talk about drone delivery. That's one to come back somehow, some way.
There's also, some of these are, trying to talk about it on a more absolute basis. And, like how high is up with, no pun intended, with drone delivery? Like,
good one.
How many deliveries can you do and not have the skies filled with drones buzzing around where people are like, it's like cell phones on planes. Like, some people are just not going to stand for that. So I think there are some limiting factors that aren't just the technology limitation and the cost. It's just like, what is the system, broadly speaking, going to handle?
Our job here is done, my friend, as is our episode. So great evaluation, hits, misses, and jury's still out. But on the whole, it looks like you were pretty good, right? I mean, if you put up the two where you're dead on, or maybe it just hasn't happened yet, looks like you know what you're talking about, my friend. So good for you. And Yeah, well, listen, it's and we get great feedback about these episodes, so we'll keep doing it. Make some predictions and then do the evaluation. This actually is a wrap on season 4. It's been a great season, Steve. It's been just a blast. We've talked to some interesting people. We've had some great discussions, and we will continue. So we've been renewed for season 5. We're going to take a bit of a break. We're going to take a bit of a hiatus as is our habit. We're going to pick up in early July, and breaking news-ish, we have a very exciting announcement to make in our preview and in our teaser and in our trailer. And for next year, we've got a very exciting announcement to make about the show, but you'll have to tune in and stay connected to social media to hear that all out. But for now...
Cliffhanger.
It's a cliffhanger.
You shot JR. There's an old school.
Remember that when TV shows used to do cliffhangers before there was on Netflix and you just watch the next one? Remember that? Like your whole season of what the heck's going to happen next, right?
In my day, we couldn't watch every show.
And MASH. MASH was a great... Anyway, all right, listen. Steve, great to be on the mic with you, as always. And that's a wrap for the season, but we'll be back sooner than you'd imagine. We'll be back on the mic. Let's leave it there. If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platforms, so you can catch up with all our great interviews, like our discussion with Target SVP Nancy King on their innovative approach to harmonized retail. New episodes will show up each and every week, and be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, producer and co-host of the Conversation with Commerce Next podcast, the Voice of Retail podcast, keynote speaker, and host of the all-new Last Request Barbecue cooking show on YouTube. You can learn even more about me on LinkedIn or meleblanc.co. Safe travels, everyone.